Over the past few days, the world has been watching a major escalation in the Middle East. Missiles, military strikes, rising oil prices, and headlines everywhere about the conflict involving Iran and US. So naturally, most people expected the stock market to crash. But something strange happened. The market didn't collapse. In fact, in some moments, it barely reacted. So the question is simple. If a war just started, why isn't the market crashing? And today in this video, I'm going to explain you the real reason and more importantly, what traders should understand about moments like this. So if you are ready, let's get into it! So when people hear the word war, they immediately imagine panic in the markets. And war means uncertainty. And uncertainty means fear. And fear means investors sell. So the intuitive chain reactions looks like this. War, panic, market crash. And sometimes that actually happens. But most of the time, markets don't behave the way that people expect. Because markets don't react to events. Markets react to expectations. And one of the biggest things you need to understand, and you need to get it with these financial markets, is that the first thing and the only thing to understand is that financial markets are forward-looking machines. So investors don't trade what is happening right now, today. They trade what they believe will happen tomorrow. And in many geopolitical situations, tensions build for weeks or even months before anything actually happens. And during that time, institutional investors are already adjusting their positions. They may reduce their risk, they hedge their portfolios, and they buy some protection. So by the time the event finally happens, a large part of the risk is already priced into the markets. And that's why traders say often, buy the rumor and sell the news. And that's what is happening right now. And the biggest moves frequently happened before the event and not after it. And another thing many people don't realize is that historically, wars rarely cause a long-term market crashes. For example, and we're gonna for this example take the chart and look at the charts directly. So during the Gulf War, and this Gulf War, it was between 1990 and 1991. The Gulf War markets actually rebounded strongly on the conflict began. So you can see it began over there, this conflict. We just got the bottom of this just retracement, and then during the war, the markets just bounced. And that's what is happening almost every time. And the same thing happens around the start of the Iraq War, And the Iraq War, it was between 2003, so 2003 and 2011. Okay, and so we just bounced over there all along during several years. Then we just got this 2008 subprime crisis, okay, but it wasn't because of the Iraq War, it was because of the US financial situations, okay, and that wasn't because of the Iraq War, because the market was already priced it. And even when the Russian invasion of Ukraine started, it was in 2022 over there, you can see that we just did a small retracement, and this retracement, it wasn't because of the Russia and Ukraine war. It was because the Fed and the Federal Reserve just raised their interest rate. And that's because we just had a high inflation, and that's why the market just retraced and pulled back a bit, and it wasn't because of the war. So yeah, during this war, markets dropped sharply at first, but then stabilized and recovered much faster than many people expected over there. And why? Because markets hate uncertainty more than they hate bad news. And that's the thing, you need to get it. And once an event actually happens, the uncertainty begins to decrease. So this market was the SPX, so the tracker on the S&P 500. And the thing is, investors can start pricing scenarios, outcomes, and timelines. And paradoxically, that sometimes stabilizes the market. And the second reason markets haven't crashed is that for now, investors believe the conflict may remain relatively contained. Okay, so right now the key question for global markets isn't simply whether there's a war or not. The real question is, will this conflict disrupt the global economy? For example, one of the biggest risks would be a disruption in global oil supply, and that's what is happening currently, because a lot of the world's oil passes through the Strait of Hormuz, and one of the most important energy routes on the planet. And if that route were blocked, and that's what is happening currently, and I'm gonna explain it more deeper just later, but oil prices could surge dramatically, and that would have massive consequences for inflation and global growth. But for the moment, and we're gonna take these markets, these charts again. So yeah, markets are pricing the conflict as a regional risk and not a systematic one. And we can see that on thanks to this SPX and the US indices, okay? And the biggest indices in US is the S&P 500. And you can see that the market isn't pricing a crash and a global a decreasing global growth. But you know that the Strait of Hormuz is completely stuck and blocked because of Iran. But thanks to Trump is he just said that he's gonna protect all the ships which is gonna cross this Strait of Hormuz. That's why I think investors are not pricing yet a dump and a recession, okay, for the moment, because US have the Venezuela oil, they have their own oil, and investors can anticipate too that the thing is gonna be great later in the near future. But the thing is, Iran just cut their production, cut their 2 sites of oil productions, and that's why when you are looking at these oil prices over there, we just had a surge on this price, and we just bounced over in only 1 week over 26%. That's massive. That's really massive. And this rise is gonna really impact all the Asia countries and not directly the America countries, okay? But later, if the China, Japan, South Korea and all these countries are really impacted because of this surge on the prices of this of oil, there could be an impact on all the things that they are exported to America and to the US. And that's how they could be an impact in this global growth, especially in America. And then if there's a real impact in this near future because of this surge on these oil prices, the global growth could decrease in America. But for the moment, there's nothing anticipated, okay? And there's another very important factor that many people overlook. Today, the biggest driver of financial markets is not geopolitics, it's monetary policy. Investors are consistently trying to anticipate what central banks will do with interest rates and liquidity. For example, the decisions from the Federal Reserve can move markets far more than many geopolitical events. If economic growth grows slow, or if inflation starts falling, central banks may eventually lower interest rates. And lower rates generally support asset prices. So even during geopolitical tensions, investors are still focused on the bigger macro picture. And if we are taking this example currently, okay, let's take a look again on the chart. If the prices of this oil keeps rising, okay, at some point the inflation is gonna be internationally. It's gonna be present absolutely everywhere. Okay, in America, in Europe, and in Asia. Okay, the inflation, the base of this inflation is the oil prices. And so, as I said, even if there's going to be an impact directly on Asia, on Asian countries, then we know that China is exporting to to every country in the world, especially USA. Okay, so there's going to be a massive inflation to US too if these prices are staying like that on this crude oil. And if everyone is anticipating a rise of this inflation in US, the Fed is not gonna lower anymore their interest rate. And that's what we can look on this CME group, the real futures market, the real markets. Okay, that's the interest rate. Okay, right now we have this interest rate at 3.75 BP. Okay, the next meeting is at the 18th March. Okay, so we have 97% of chance that the Fed just maintains their interest rate. The 29th April. Okay, we have 87% of chance that it's gonna maintain the interest rate too. In the 17th June, we have already lower chance to maintain these interest rates. Okay, and as you can see, so 1 week ago, that's the current interest rate. 1 week ago, only 1 week ago, we had 42% of chance to maintain this interest rate and almost 46% of chance to lower the interest rate about 25 BPs. So it means we had 1 week ago more chances to lower the interest rates during the 17th June than right now, than currently. And this was because of these geopolitical tensions. Okay, and these geopolitical tensions, all the investors are anticipating a more important inflation in US than the original one. And it's supposed during this summer that the Fed should reduce their interest rate. But with this war, we are not anticipating anymore this lowering interest rates. But despite of that, these markets just maintain, these markets just stabilize. And that means that this growth economy situation and all the stocks, all the Magnificent Seven, all the biggest companies in US, everyone are anticipating that they are making some profits and this situation is gonna stay great. So what does all of this mean for traders? Moments like this usually brings one key change to the markets. It's volatility. When geopolitical news hits the headlines, you often see sudden spikes in volatility, aggressive reactions to news, sharp reversals, and sometimes very chaotic price action. And this is where traders make mistakes. They chase headlines, they overtrade, and they increase their risk because the market is moving faster. But the reality is that volatile environments reward traders who stay disciplined and structured. And the edge doesn't come from predicting the news, but it comes from having a system and executing it consistently. So if a war just started, why hasn't the market crashed? Because markets don't crash because events. They crashed because of surprises. And right now, investors are still trying to evaluate how big this situation could become. And the real risk isn't necessarily the headlines we see today. The real risk is something the market isn't expecting yet. And that's the part traders should always pay attention to. Because in financial markets, the biggest moves almost always come from what isn't priced in. Hope you liked to watch this video. If it's the case, don't forget to hit the thumbs up and subscribe to the YouTube channel, and of course activate the ring and the notification. We'll see you in the next one or in trading live stream on the Phidias Pro Firm YouTube channel, the best pro firm in the world, and soon the #1. So make sure to use the code FLT if you want to sculpt your trading success and enjoy the best offers that they're offering. Phidias Pro Firm. We'll see you in the next one. Have a trade safe and have a good day, good evening, or whatever. See you soon. It was Florian Brander. Bye bye bye.
Yo, his name is Florian. He's the NASDAQ hustler. Every day he's grinding, making all them numbers cluster. He's a day trader, living life as a thrill seeker. Analyzing charts, he's the Wall Street sneaker. 9 to 5 ain't his game, it's the stock market flow. Tickers on his mind, watching those numbers grow. Buy low, sell high, that's the name of